welcome to the Deep Dive. So today we're digging into something that, on the surface, looks like purely Chinese domestic policy.
Right, China devaluing its currency, the yuan.
Exactly. But, it's not just a local story. It creates these big ripples, and emerging economies often feel them pretty strongly.
They really do. It's a classic example of just how globally interconnected things are now. A move like that in Beijing can trigger effects thousands of miles away.
Our goal here is just to cut through the noise, give you the core understanding of these impacts without getting totally bogged down in jargon.
Sounds good. Where should we start?
Okay, let's kick off with maybe the most obvious one,
Right.
the competitive pressure. How does a cheaper yuan make life harder for other exporting countries?
Well, it's pretty straightforward, really. A weaker yuan means Chinese goods cost less in dollar terms or euro terms, whatever.
So they get a price advantage on the global market.
Precisely. And think about the sectors where China is huge: electronics, textiles, maybe machinery parts. Other emerging economies, say Vietnam, India, maybe Mexico, Indonesia, they compete directly in many of those same areas.
So if you're a buyer, maybe in the US or Europe, you're looking at similar products, and the Chinese one is suddenly noticeably cheaper.
Yeah. And often price is a major driver, isn't it? So orders might shift towards China, even if the quality from, say, Vietnam is comparable.
Which directly impacts those export-focused economies, especially places like Southeast Asia that rely heavily on factory orders.
Absolutely. Fewer orders mean potentially slower growth, maybe weaker job markets. It's a direct hit to their export engine.
Okay, so that's the competition side, but it also works the other way around, impacting what these countries sell to China, right?
Exactly. Because if the yuan is weaker, it makes imports more expensive for Chinese companies and consumers.
Right, so flip the coin.
Yeah. So think about countries that export a lot of raw materials or components to China. Brazil selling iron ore, South Africa, maybe copper, Malaysia with palm oil, that kind of thing.
Those commodities become more expensive for Chinese buyers to purchase.
Correct. Which means those Chinese buyers might cut back on their orders or look for alternatives or just, slow down purchases.
So Brazil's export numbers could take a hit simply because the yuan fell against the dollar.
That's a very real possibility. And it's not just raw materials. Think about consumer goods, too. If imported stuff gets pricier for the average Chinese person because of the weaker currency,
They might buy less of it? Fewer foreign brands, maybe?
yeah, potentially. Their spending power for imported goods decreases, so that makes the Chinese market, maybe a bit less attractive for exporters and other emerging markets trying to sell finished goods there.
Okay, so it's pressure on their exports out and potentially lower demand for their exports into China. A
Yeah.
sort of double squeeze.
That's a good way to put it. Yeah, double squeeze. But there's actually a third layer, too, related to financial markets and investor confidence.
The capital flows aspect.
Right.
Currency jitters.
Exactly that. A sharp, unexpected drop in the yuan can sometimes make global investors a bit nervous.
Why is that? They see it as a sign of instability in China itself.
Sometimes, yeah. Or just uncertainty. And when investors get nervous, they often pull money out of assets they see as riskier.
And emerging markets often fall into that riskier category for big global investors.
They do. So you can see what's called capital flight money flowing out of these developing economies.
Okay, and what does that capital outflow do to those emerging markets?
Well, the most immediate effect is pressure on their own currencies. If lots of capital leaves, their currency tends to weaken against major currencies like the dollar.
And a weaker currency causes problems.
Yes. For one, it can fuel inflation because imports become more expensive for them. And second, many emerging market governments and companies borrow money in U.S. dollars.
So if their local currency weakens, that dollar debt becomes much harder and more expensive to pay back.
Precisely. It increases their debt burden significantly, which can create real financial stress.
Wow. Okay, so let's just recap quickly. China devalues the yuan. That means, one, their exports get cheaper, putting pressure on competitors in other emerging markets.
Right.
Two, imports into China get more expensive, potentially reducing demand for raw materials and goods from those same emerging markets.
Yep. The demand side hit.
And three, it can spook investors, leading to capital flowing out of emerging markets, weakening their currencies, potentially causing inflation, and making dollar debts harder to handle.
That sums it up pretty well. Increased competition, decreased demand, and potential financial instability. It really highlights just how tightly woven the global economy is.
It really does. A decision made for domestic reasons in one major economy has these significant, sometimes quite complex knock-on effects elsewhere.
Absolutely. No country is really an island in economic terms anymore.
It definitely leaves you thinking. Given this interconnectedness we've just discussed, what other kinds of seemingly internal policy decisions, maybe in other major economies, might be having these big, unforeseen global consequences right now? Something to chew on. Thanks for breaking this down.
My pleasure. It's a crucial dynamic to understand.